Namaste everyone. I, khushboo jangid, working as an assistant professor in the Department of Commerce and Management at Jayoti Vidyapeeth Women's University, Jaipur. Today, we will discuss ratio analysis further. Ratio analysis is divided into two parts: structural classification and functional classification. Functional classification is further divided into 5 parts: liquidity ratios, second is activity ratios, third is profitability ratios, fourth is capital structure or leverage ratios, and fifth is investment analysis ratios. In the previous videos, we have already discussed structural classification and liquidity ratio and activity ratios of functional classification. In this video, we will talk about profitability ratios. As the name says, earning profit is actually the main aim of every organization. If the organization will not earn adequate profit, then the organization will face difficulty in meeting the daily expenses of the organization, and dividend also will not be paid to the shareholders. Profitability ratio is also called general profitability ratios. The profitability ratios are further divided into two categories. First is profitability ratios based on sales, and the second is profitability ratios based on capital or investment. In this videos, we will talk about profitability ratios based on sales. Profitability ratios based on capital or investment we will do in our next video. Profitability ratios based on sales are divided further into 5 parts. First is gross profit ratio, second is operating profit ratio, third is operating profit ratios, fourth is expenses ratios, and fifth is net profit ratios. On the other hand, profitability ratios based on capital or investment are further divided into 4 parts. Return on capital employed, second is return on net worth or shareholder funds, third is return on equity shareholders funds, and fourth is return on total assets. In this video, we will talk about ratios based on sales only. The first ratio is gross profit ratio. Gross profit is basically the excess of proceeds of cost of goods sold and services rendered during a period over their cost. Now we'll talk about how can we calculate this ratio. It is calculated by deducting cost of goods sold. मतलब जितना cost लगा है हमारी product को बनाने में from net sales. Net sales में से cost of goods sold को we will subtract and we will get gross profit. This cost of goods sold includes purchases, direct expenses such as carriage and wood, octroi, etc. And net sales simply means total sales minus sales return. जितनी sales हमने की हैं उसमें से return को we will subtract and then the remaining sales is known as net sales. Now, this ratio basically shows the relationship between gross profit to sales. The formula to calculate gross profit ratio is gross profit divided by net sales multiplied by 100. There is one more formula to calculate this ratio, and that is net sales minus cost of goods sold divided by net sales multiplied by 100. Now let's understand this ratio with the help of an example. One example is given here. It says if the net sales of a company are of rupees 2,53,800 and the cost of goods sold is 1,52,280, then calculate gross profit ratio. See, in the numerator we have to calculate gross profit, or here gross profit is not clearly given in the question. Instead, net sales is given and cost of goods sold is given. By subtracting these two amounts from net sales, by subtracting cost of goods sold, we can get gross profit amount. And in the denominator, we just have to write net sales multiplied by 100. After calculating the value, we'll get gross profit ratio, and that is 40%. Let's do one more example to understand this ratio. Gross profit of a company is 25% of cost of goods sold. The question says that if credit sales are twice its cash sales, if the credit sales are of rupees 4 lakh, calculate gross profit ratio. To calculate gross profit ratio, we require two things, net sales and gross profit. To calculate net sales, first we have to take both the kinds of sales into consideration, credit sales also and cash sales also. Credit sale is already given in the question, that is amounts to 4 lakh. Now the question says that the credit sales are twice its cash sales. That means the cash sale is basically half of credit sales. Half of credit sales, that means half of 4 lakh, that is 2 lakh. So with this information we have got credit sales also and cash sales also. So total sales will be 6 lakhs. Now gross profit is already given in the question, but it is in percentage. We have to calculate in the amount. 6 lakhs multiplied by 25% divided by 125 is equals to 1,20,000. This is the gross profit of this organization. Now, with the help of these two, we can easily calculate the gross profit ratio. We just have to divide this gross profit divided by net sales. 1,20,000 divided by 6 lakh. Now, this is the interpretation of the ratio. What does this ratio show? If the ratio is higher, that means the margin is also greater. That is why it is also called margin ratio. Now, there can be numerous reasons for increase in gross profit. Some of the reasons are given here. First is higher selling price, but cost of goods remains the same. अगर प्रोडक्ट की सेलिंग प्राइस इज वेरी हायर और कॉस्ट ऑफ गुड्स सोल्ड इज लो, या फिर जितनी पहले थी उतनी ही है एंड सेल्स वी हैव इंक्रीज्ड, तो द मार्जिन विल बी हायर. Or one more reason is lower cost of goods sold but selling price remains the same. Somehow we have controlled the cost of goods sold. Cost को we have controlled and we have decreased a little bit, and selling price is the same. So what will happen in this condition? Sales are same, cost has been reduced, so margin will increase. Or we can adopt some kind of combination, सेलिंग प्राइस और कॉस्ट के बीच में ऐसी स्ट्रैटेजी बनाएं सो दैट द मार्जिन इज मोर. There can be some other reasons also. Now let's discuss what if this ratio is lower. Low gross profit ratio basically indicates that the organization is having some downtime. That means the profits are declining of this organization. Again, as we have discussed the the reasons for higher margin, there are some reasons for lower margin also. Some of them are discussed here, are written here. Profit are declining in comparison to sales. हमारे profits sales के compare के अंदर कम होते जा रहे हैं, and इसके there can be numerous reasons for that. Or the other reason is production costs are much more due to inability to purchase raw material on reasonable terms. अगर raw material की price has increased और labor की price is increased, and due to some reason we have to keep the selling price the same as previous, the margin will automatically decrease. Now let's move on to the next ratio. The next ratio is operating ratio. Operating ratio basically shows the relationship between operating cost and net sales. Now what is operating cost here? Operating cost means cost of goods sold, means जो हमारी cost है goods की plus operating expenses are operating expenses. The formula to calculate operating ratio is operating expenses divided by net sales multiplied by 100. There is one more formula to calculate this ratio, and that is operating expenses plus cost of goods sold divided by net sales. Now let's understand this ratio with the help of an example. One question is given here. A company's net sales for the year is 2005. For the year 2005 are 1,80,000 and cost of goods sold is 1,20,000. Operating expenses are again given here in the question, that is 19,500. Now you have to calculate operating ratio. The formula to calculate operating ratio was operating expenses plus cost of goods sold. Here operating expenses is 19,500 and cost of goods sold is 1,20,000. We just have to add these two amounts, divide it with 1,80,000 with net sales 1,80,000 and multiply with 100. After calculating, we'll get the answer operating ratio, and that is 77.5% here. Now let's understand what this ratio shows about the organization. A higher ratio would indicate the expenses are more than the company's ability to generate sufficient revenues. That means the expenses are higher but the ability to generate profit, revenue is lower. That is why it is considered as inefficient. Whereas low ratio is basically a good sign for the company's expenses. The low ratio shows a good sign for the company. That means company's expenses are less and revenues are higher. Now let's move on to the third ratio, that is operating profit ratio. It is also called operating profit margin. It shows the relationship between operating profit and net sales. The formula to calculate operating profit margin is operating profit divided by net sales multiplied by 100. Now, how can we calculate operating profit? The formula is gross profit minus operating expenses. Or if we already know, there are three formulas. First is operating profit divided by net sales multiplied by 100. The second method through which we can calculate operating profit ratio is gross profit minus operating expenses divided by net sales multiplied by 100. And if we already know the operating ratio, then also we can calculate operating profit ratio by subtracting operating ratio from 100. 100 minus operating ratio. Higher operating ratio, that means better operational efficiency of the company. Basically, it means that company has not only increased its sales, but the operating expenses also has been reduced by the company. Now, let's move on to the fourth ratio, that is expenses ratio. Basically, in the day-to-day work of any firm or organization, company has to incur a lot of expenses. So, this ratio basically shows the relationship of different expenses to net sales. First is material consumed ratio. The formula to calculate this ratio is material consumed divided by net sales multiplied by 100. Manufacturing expenses ratio is equals to manufacturing expenses divided by net sales multiplied by 100. Administration expenses ratio is equals to administrative expenses divided by net sales multiplied by 100. Selling and distribution ratio is selling and distribution expenses divided by net sales multiplied by 100. Finance expenses ratio is finance expenses divided by net sales multiplied by 100. Non-operating ratio is equals to non-operating expenses divided by net sales multiplied by 100. Basically, जिस भी expenses की we are talking about, जिस भी expenses की हम बात कर रहे हैं उसे ऊपर लिखेंगे and we have to divide it with net sales multiplied by 100. The last ratio is net profit ratio. This ratio measures the relationship between net profit and sales. To calculate this ratio, the formula is net profit after tax divided by net sales multiplied by 100. One more formula is there, and that is net profit before tax divided by net sales multiplied by 100. I hope you must have understood all these ratios properly. In the next video, we will talk about profitability ratios, remaining profitability ratios. Thank you.